Okay, welcome everybody. My name is Geoff Green. I'm going to be your host today. Thanks for joining us for the May 2022 housing market update. Let's jump right in. There's a lot to talk about. Today's topic is, are we headed for a housing bubble? Should be some interesting information here so that you can make up your mind as to what you think is going to happen. So just a quick look at our panel. We're going to hear from them in just a little bit, but like I said, let's jump right in. There's a lot to talk about. So here's a general look at home price appreciation since the 40s. And you can see that it's really been on the climb ever since, with one big dip. And that was thanks to the financial crisis back in 2006, right through 2016, basically. So you can see here that, the market lost a lot of ground from 2006, but has since regained. And you can see how we have such a steep curve right here heading up to 2021. So when you look at this chart, you say, man, this thing has got to settle down. There's got to be some sort of downturn coming here, right? But not so fast. The first thing to look at is, well, how are forbearances doing, which are really the first part of the foreclosure process, right? And you take a look at, when the pandemic started and the government released all these programs for forbearance, how many people got in, and then you can see steadily how they've gotten out to where we are now at a very historically low rate of forbearance. So that just means basically people are paying their mortgages, they're staying current, they're not in trouble, so to speak, at least not yet. And then taking a look at, what happened with people when they came out of forbearance. 37% of people actually paid in full. That means they probably sold the home or did a refi, right? 44% were workouts or repayment plans. So quite a few did make deals with the banks in that forbearance period and are still on those. And about 18.4% are still in forbearance and in trouble, so on and so forth. But 1.3% are short sales, deed in lieu repayment plans, so on. It's a very small sliver, which is a stark comparison to where we were in, let's say, 2009, 10, 11, 12, 13, 14, where short sales were all the rage. So this is a quote here from Danielle Hale, chief economist over at Realtor.com. We have learned from history that prices can fall. The more important question is if it's going to happen right now, and that is hard to say. And I would agree with that quote. That's probably really sums it all up. Lending standards, default risk in the mortgage market. I think that this is, a really important point to note is, the variances in the risk tolerance between, the lenders themselves, the product risk and borrower risk, is lower, and there's not as much of variance. So that's a good metric. And also taking a look at just foreclosures in general. We took a look at the forbearance issue before, but take a look at the foreclosure situation. Obviously, you can see the market just started to fall apart in 2006, and then it really just, the financial collapse really just took place, and the peak of foreclosures happened in 2010. It's been a steady decline ever since, with a really more rapid decline once the pandemic hit. You can see there in between 2019 and 2020. And now we're just really at such a low level that it's almost non-existent. And that really is the case because the market is just absorbing things so fast that there's just no inventory. And whether it's a foreclosure or sale of somebody's regular home, they're just not sticking around. Another key factor, and I've been saying this for the last 10 years basically, is that lending standards got tighter. People have more skin in the game. They've had to have better credit to get the mortgage. There's been less creative financing going on. So a lot of the loans that have been written in the last 10 to 15 years have been much more solid than they were back in these years here. I mean, that was really the issue in these years. It was a free-for-all and anybody could get a loan. There was hardly any skin in the game, so to speak, right? So you can see it's been, pretty steady here as far as the lending standards go. So that's a good thing. And I think that is one of the big reasons why we're not going to see a major collapse, at least on the financial side of the real estate market. And then the other thing that's important to note is, well, how much debt is outstanding? How much household debt is there for the general population? And you can see we are at a historical low. And this pertains not just to equity in the home, right? It doesn't pertain to equity. It's actually disposable personal income, which is important, right? Because disposable personal income is the income that people can actually use to pay to service their debt. So it's really at, a 30, 40-year low, where we are today. So that's also another good signal. And again, taking a look back at where it was in 2007, it was at an all-time high. So that's good news. And this is basically saying that, mortgage payments are virtually unaffected. This is, the difference in annual mortgage payment for cash out refis. There's just not a lot of them happening, meaning, one of the big problems back in these days was where people were doing cash out refis, taking that cash and using it to buy cars and other things that were unrelated to the real property asset, right? So that's not necessarily a good thing. And you were seeing a lot of that taking place in 14, 15, and it kind of peaked in 2018 because rates were on the way down. Equity was finally coming back. So people that got stuck, that might have bought something in 2006 or 7, they were really in a bad spot. They couldn't do anything or get out. So a lot of them took advantage. And I think that's why you see these numbers here. But look at what's going on ever since. I mean, there's just not much money being taken out against the homes as of right now. And now that rates are coming up, probably not likely that that's going to increase in terms of cash out refi. So what is ahead? Home price forecast for 2022, pretty much everybody is still showing a major increase in price. And it's largely because of supply and demand issues. We just spent a lot of time on the financial side. We see that, there aren't really crazy financial programs for people to get mortgages. I mean, we are in a true supply and demand situation with the housing market. And this is just the average of all of, let me back up one slide. So all of these here, right? There's a 9% average for 2022, which you see that carry over to 22 here. And all of the averages of all those different sources of information are saying for 23, for 24, 25, 26. So this is a really aggressive, forecast. And I can say that, we've been doing the housing market update every month now for a bunch of years. And as I've been watching these forecasts, they've pretty much been wrong, meaning that they've been low. It's really like, if you were to look back a year and a half ago, they weren't going to project a 9% increase for 2022. That just was not in the cards. It was more like 4 or 5%. So it's possible that, these could be inaccurately low, if you would. And then here's a look at, cumulative house appreciation by 2026. More people are optimistic that houses will continue to appreciate through 2026. So here's another quote here that's pretty relevant. We wanted to include this one. Based on the current estimate for the peak Fed funds rate, right, 3.75 to 4, the 30-year fixed mortgage will likely peak at between 5 and 5.7%. There is some variability in the relationship, so we might see rates as high as the low 6% range. Now, I've been hearing some people say, oh, rates are going to be 9 or 10% by the end of the year. I mean, that's pretty drastic. I doubt that will happen, but who really knows? Because there is such inflationary pressure here. We have very astute financial planner to talk about the bond markets and whatnot today. That's Ken Ford. We're going to hear from him in a little bit. But this is, I think, more realistic, that rates are going to probably land somewhere in the 6% range. So really what it comes down to is affordability. And affordability is the issue, right? Like the most important thing is that as many people as possible own a home because they control their situation. Actually a friend of mine called me the other day and said, Geoff, my landlord just raised my rent $700 a month on me. I have to buy a home. That's really a tragic situation, right? He's out of control. When you're a renter, you're not in control of your home, and it's important to own your home. So basically the long and the short is affordability, right? And you want to be able to make sure that people can get into those homes. So, 84% of Americans plan to cut back spending as a result of price spikes. More than 70% of respondents say they're feeling the effects of inflation the most in gas and groceries. That's a quote from Bloomberg. So, but the thing is to take a look at, so you start to think like, all right, so affordability is a real issue, right? Because everything's more expensive, not just housing. And that really says, well, are people able to afford the homes? And, there are some, like if you just take a look at the average, loan amount of 300,000, October of 22 versus 21, it's basically a $500 a month difference. I mean, for most people, that's huge, $6,000 a year, that's a big deal. So, how does that stack up? Well, bottom line is, when you take a look historically about affordability, we're actually in pretty good shape, because the reality is, going back to, personal disposable income, which we talked a few slides back, there's relatively a lot of personal disposable income in general for people. I'm not saying everybody's doing well and everybody's making enough money to live the life that they want, but in general, statistically, we are at a very good level of housing affordability right now. That doesn't necessarily mean that 6 months from now, this chart is going to remain the same, but right now, historically, we are not at a bad time. Okay. So that's good news. It means that most people can still afford to buy a home. As crazy as it is and as high as interest rates are, they can afford it. Whether or not they can persist is another story. So the average consumer is spending an additional $429 monthly for items other than shelter. That's pretty alarming. Meanwhile, average weekly wages rose just $212 per month. So there's a deficit, right? The consumer is short by $217 per month. So that means that the average consumer will be looking for a home that is $41,000 cheaper. That's how you extrapolate all those numbers. So yeah, should there be some downward pressure on price? Yeah, there should be. We're just going to have to see if the amount of demand decreases and supply increases, because at the end of the day, that's what's got to bring it back to focus. So we're going to join our panel right now. But before we do that, join us on June 17th for the next housing market update. You can always stay informed at hmupdate.com. And a thank you to our sponsor, NewOp, the Business Opportunity Exchange. If you're a real estate agent or a mortgage banker and you're not yet on NewOp, you're crazy, because there's a business being exchanged there all the time. Definitely check it out. All right, let's check in with our panel. I see Chad, I see Ken, I see Vikki, I see Keren. Welcome everybody. Thanks for being here. Let's start out with our realtors, boots on the ground, Keren Gonen. Keren,
yes.
A frequent panelist on the housing market update. I ask you all the time, how's it going out there? Are you seeing any sort of decrease in buyer activity, showings, deals being put together? Where are things at with you?
I think for me, what I'm experiencing is it's still a seller's market. Sellers are still expecting to get the most out of their investment, which is why they should definitely be working with a local professional agent to assist them so they can maximize their investment. The buyers, on the other hand, are getting a bit apprehensive about the interest rates. I don't think they fully understand that if you don't buy now, the rates are going to climb. So buy now, lock your rate in now. Let's go find a house as soon as possible.
Okay, Vikki, are you feeling the same way, or?
I do. Yes, I agree with what Keren said. I do think there are buyers. Maybe they've heard your advice, Keren, but they are trying to hurry up and get it in quickly. We're still, we still have bidding wars, at least, multiple offers depending on the price range. I've heard, over a dozen offers on a house. My last 2 listings both sold within a weekend, just within the past few weeks. So it's, I agree, it's still a seller's market.
Yeah, there's no question about that. But I think that, people do recognize that they need to keep moving. And to me, the other thing is this: look, if you don't own a home and you need a house, it doesn't really matter when you buy, because if you're going to stay in that house for a long duration, it'll all even out in the end. And even if you're buying a home that's maybe smaller than what you're ultimately going to need for your life, you're in the game so that the next time you do a transaction, you're going to buy and sell in the same market. So that almost doesn't even really matter either. So the most important thing, if you don't own a home, is to get a home that you own, no matter what market you're in. Because if the idea is that you're going to be in it forever, hopefully you're going to be a homeowner for the rest of your life. So it doesn't really matter when you make your next exchange, because it all kind of evens out, and I just think it's most important to control the roof over your head. It's very
Jeff, the
important.
other thing I want to mention is that a lot of landlords are increasing the rent to such a position where you may even pay less if you're
Yeah.
buying as opposed to renting. So the
Yep.
other thing that's really important to do is to be paired up with a lender that has different programs, because there are different programs. For instance, I was talking to a lender earlier this morning, and she told me that the interest rate on an FHA loan is much lower than the interest rate on a conventional. So buyers do need to get out there, and the rent are just, I can tell you, I have a house that's a 2-bedroom, 1-bath, where a year ago I'd rented maybe for $1,100. It's being rented out at $1,800 and gone in a
Wow.
day.
Yeah.
So the rates are totally different. Rents are super high. And if you're going to pay $1,800 for a 2-bedroom, you should pay it for your own purchase instead of someone else's mortgage.
Yeah. No doubt. All right. That's good information. All right. So Chad, let's check in with you, and then Ken, we're going to round it out with you. How are things going? I have to think things have slowed down for the mortgage industry, because refis are probably not happening right now, right?
No, refis, as everybody knows, because the interest rates go up, what's the point of refinancing unless you have to pay off some debts,
Mm-hmm.
or you're going to leverage your property to buy an investment. So with that respect, a lot of people are refinancing because the equity position has grown so dramatically in their homes. What are you going to do with all this equity? Well, let's invest it and let's buy another property, hence an investment property. So it just depends on the person, but in the grand scheme of things, yes, refinances for a better rate and a lower payment are pretty much done and done with. With regards to the housing market, everybody knows it's very difficult because the inventory, there's a shortage. So when we talk about the housing bubble, I don't foresee a bubble. I just see the lack of inventory and things staying at a moderate pace where, again, supply and demand, that's what's causing the bidding wars.
Yeah.
20,000, 30,000. There's homes that are done 150,000 over ask. People don't care.
Right.
Relate that to the interest rates. People need a place to live. It's their home. Unless you're looking to flip it, it's an irrelevant conversation. It's only what somebody's willing to pay. So if you have a family of 4 or 5 and you need a place, doesn't matter how much you're going to pay over. It's the purpose that it's serving, which is more important than the price.
Are the appraisals keeping up, Chad?
Well, I'll give you an example. I had a property under appraised by $80,000. $675,000 place, and it came down to from 675 to 605. And I had the conversation with the buyer. Case in point, are you okay buying this house? Granted, he was putting down 300 and change, so the equity position and the appraisal was a moot point. And he said, "Listen, this house serves my purpose for my family.
Right.
5 people, my mom, my dad, my kids. I don't care. I'm going to be here forever." Just like you said.
Yeah.
So it's becoming a little bit more difficult as far as the appraisals. Yeah. And that's why a lot of people are apprehensive to kick out the first time buyer with, very little money. FHA, appraisal issues, 5% down. Unfortunately, these people can't compete with higher down payments because of that appraisal being upside down.
Okay. Good stuff. Chad Barris from Family First Funding. Ken Ford, Warwick Valley Financial Advisors. Let's come over to you. Ken is a guy that always has a little bit of a pessimistic view on everything, which is why I like having him as my financial advisor. Because he's sharp, he's shrewd. So Ken, what do you think, man? I mean, you're sitting here hearing a bunch of realtors, kind of paint the rosy picture about no bubble bursting. Same thing from the mortgage banker on the panel. What say you?
Why do you bring me on at like crazy times in the world? Like the last time, Jeff, I was on was the beginning of COVID. I
Yeah.
wanted to listen to it. I really would like to get recordings of this, but yeah, when COVID hit, could I not, I guess, how do you think, how could you ever, and if I could go back, whatever, two years when this happened, what transpired was just crazy, and you could never calculate that of what happened.
No.
I was talking about, why did stocks do well coming out of COVID, right? You couldn't dream that everybody was getting a paycheck. The PPP loans, what did we go up? $8 trillion in debt.
Mhm.
So you think back, and now it's easy, right?
Mhm.
Hindsight's 2020. But as it's unfolded, I'm like, how are people going to keep their jobs? And if they can't keep their jobs, how are they going to pay their mortgages? And then what do we get? Forbearances, and we got things that are unrepeatable. So if we want, I will take the other side of everything that you're saying, just because I'm someone that likes to buy things on sale. I'm an investment advisor. I want to buy assets on sale.
Right.
And how do you buy something on sale when 20 people want to buy it, right? You show up I hear bidding war. I'm like, well, I'm not going to a bidding war. I have clients call me, what do you do with real estate? I said, you rent, you just sit here. What do you mean? You want to get in a bidding war with 20 other people? So, let's address the bubble topic, right? There's only one indicator that I'll look at in housing, and it is the Case-Shiller National Home Price Index. And I'll ask a question to the whole panel. Was 2006 to 2007 a bubble in real estate?
Yes.
Okay, if we look at the Case-Shiller index, it's supposed to be at 100, and the Case-Shiller index takes the income of a town, a city, a region of the markets, right? I think there's like 10 or 12 different regions that the Fed looks at. And when Case-Shiller, what are two professors, one at Yale that won Nobel Prize in economics for this indicator, came out and said, hey, we started this indicator at 100, and in 2006 it got to 180. So if you looked at it, that was a bubble. You look at it today, Jeff, I don't know if you've looked at this thing in a while. If you look at the chart, we are almost twice as high as 2008's peak. So if incomes don't rise and home prices do in the area, it starts to get uneconomical eventually. You have to have rising incomes in order to keep up with rising home prices.
Mhm.
And that's what the indicator is telling you today, that incomes are not rising as fast as home prices, and that's not sustainable. So let's, there's a very smart guy that said, don't look at today, look 12 to 18 months out. So what is going to drive your world? And I'll tell you what's going to drive the real estate world is interest rates. Okay, so what determines an interest rate? And now we have the Federal Reserve talking about, what'd you say? The getting up to
3.25 to 4.
to
is-
4,
Yeah.
right? I will call their bluff. I don't think they can raise interest rates to 3 or 4. We just have too much debt, and something will break before they get there. But they might have to do it because you have 8% inflation rates, and they're probably higher than 8%.
Mhm.
You're not calculating 20%, 25% of the index is the cost of housing, right?
Right.
But they don't use rents like you guys are renting houses. They don't use home price appreciation. They use something called homeowners equivalent rent, which means if Jeff, did you rent out your house last year?
Did I rent out my house? No, I
You
did
live
not.
in it or rent it? Did everybody that owns a house rent theirs, or are they living in it, right?
We're living in it. Yeah.
Yeah, but their statistic says that if we rent our houses out, this is what we should get year over year, but it didn't happen because we don't rent our houses out. So if they applied that, inflation would be higher than 8%. So let's just use the 8% number. If you go to an economic textbook, interest rates are supposed to be higher than inflation rates. And let's get optimistic. I don't think 8% inflation year over year can persist. It did just because of supply chains and a number of other factors. So it is going to come down, and that's the question. 12 months to 18 months, what is the inflation rate? Is it back to 2% like they think or hope it might be at, or are we at 4 or 5%, or are we at 8%? That's the magic number. But right now, if at an 8% inflation rate, we're supposed to have a 10-year bond above that number. We're supposed to have a 9% 10-year treasury bond right now.
Mhm.
You know, that's in 101 economics is you're supposed to have interest rates above inflation rates. And I sit here saying, there's no way of getting that. And
Right.
that's the only way that you could kill inflation. If you
Mhm.
went back to the 1970s, we got up to like 13, 14, 15% inflation rates. How did it come back down? It came back down because we went to 15% interest rates.
That was Volcker, right?
Volcker raised it to 15%. And now we're hearing, oh yeah, the new Fed chairman, he's going to be like Volcker. I'm sitting here saying, you really,
Yeah, it takes a lot of political will. People wanted to murder that guy back in those days.
they were sending 2x4s and bricks to the Fed chairman saying, stop it, because the home prices were getting killed.
Yeah.
So I don't know where interest rates are going to go because I got to figure out where inflation is. I don't think it's going to be 2%. And I don't know if it's going to be 8% either. It's going to be somewhere in between. So now Chad may know this, but Chad, what happens if we go to a 6% 10-year bond? Where are we at mortgages?
Honestly, again, going back to what I had said, it's not about the interest rate. If the rates are 8, 9%, people still need to live somewhere. They still need a house. The biggest thing from what I see is gas prices, because everything that gets into somebody's household
Right.
is predicated on gas,
Yeah.
the fuel. So at this point in everybody's lives, do I fill up the tank another half a tank, or do I need the other $40 to put food on the table?
Right.
As far as the mortgage rates, I've been doing this for 20 years. I mean, whether the rates were 2% or 8%, I don't think that's as important as the true Main Street cause and effect of what the gas prices are.
Well,
But it is interconnected. It is interconnected into affordability and whatnot. But
you
Well,
buy
with
on a
the
monthly
affordability, and just real quick, and then I'll let you get back on, where the affordability comes in, it's not the mortgage rates. It's the Fed funds rates that affects the credit cards and what banks lend each other and everything else that goes along this chain. The actual mortgage rate that somebody can predict their mortgage payments, at the end of the day, it's a fixed payment. All the incidentals, again, whether it's lawnmower fuel or getting to work, people have to cut back because their income is not going up as fast as the gas prices and the expenses are. That's where this whole thing's gonna, go upside down.
Traditionally, everybody buys with a monthly payment. It's okay, let's do the house. I put X amount down. What's my monthly payment?
correct.
But if you start going and they actually have the guts to raise interest rates to those levels because they have to break inflation. And that's the conundrum that they put themselves in, is they should have started raising rates early, not let inflation get out of hand. But if they want to tackle inflation, they're going to have a lot of guts. And I don't think they'll have the guts to get to,
But just remember, the only people that this matters to on this escalation is the people who have been looking for the last year as they've been watching it. Someone who's making a decision this month right now, they didn't know what it was back then because they never got involved. Now this is all new. It's kind of filtered out for a whole new slew of buyers.
I think a realtor would chime in. It's a monthly payment that you buy a house on. Now, I do know there's people with a lot of cash and investments did well, and maybe they had, had a $500,000 in the stock market and it doubled and they got an extra 500 grand and they come and they become a cash buyer, right? Well, if interest rates go higher, I talked to a guy yesterday in the park. I go, you financial guys, I lost a lot of money last month. And I said, if they raise interest rates, stocks don't like that. Okay. If they start paring down their balance sheet and drain liquids, assets don't like that. It liked it when they went down and they printed money. They really liked it. That's why the stock market went up so much. So if you do that in reverse and you take away the wealth effect, and now you make monthly payments go up, I cannot be optimistic that I think prices rise. I think if Vikki and Keren chimed in and said, when you're talking to someone that buys a house, do they care about what they pay per month? And give me a 7% mortgage versus a 2.5% where we were last year. And the monthly payment is there's a quite spread between those monthly payments.
Yeah, but at the end of the day, if there's no inventory and you need a house, you're going to pay more for it. And I think that's what's unique right now about the real estate industry, is that there is so little inventory.
If I could spend $35,
it's nationwide.
And that house now costs me $5,500 a month. Where am I getting the extra $2,000? And then gas prices is going to be a real shocker. because we have a really bad energy problem and we better change it quick, or else you're not going to see $5 at the pump. We're going to go a lot higher on gas if we don't tackle the problems that we're having with supply and demand issues in fossil fuels right now. We're trying to get off fossil fuels and it's not working, but we go to $7 at the pump,
Right.
which is in California, by the way. And if
We haven't even hit Memorial Day yet.
Yeah.
we hit the driving
it's a
season,
problem.
and oil inventories are 40-year lows. And we just drained all our strategic energy reserves for the Ukraine war. And oil companies can't produce anymore because their policies tell us that these energy companies shouldn't. So if inflation persists, people have less money to spend, gas prices stay elevated and they go higher, I just can't be that optimistic that we don't revert some of this backwards. And I think the interest rates are the key to all this. So nobody knows.
But I just don't see a crash in the housing market. I don't see that happening because there is so much demand for the little inventory that's out there.
And
I just don't see it. I'm going to show you guys something. This is a slide that I've been showing now for a few months. This is a really interesting chart on just population, right? And it shows how massive Gen Z is. You can see, the further out the line goes, the more people there are. It's the largest population basically coming of age and first-time buyer situation. You couple that with the fact that people have gotten out of the cities because of COVID. Businesses have adjusted to allow people to work remotely from home. You're pushing a huge population out into the suburbs where all the single-family homes are being built. And that's why you have what you have.
I'm gonna agree. One of the things that's gonna keep real estate probably from going down, crashing, is the cost to build a home. So all these materials that go into it, whether or not it's wood or copper piping and everything else, if they keep on going up, and you talk to builders these days,
hard to pencil,
so your home is going to be valuable because of the replacement costs of all these materials. So I'm not going to be that negative because yes, we don't have a lot of supply of homes. It's very difficult to buy the materials and even get them these days. So we're not going to go gangbusters building homes because they can't even get the materials to do it. So
right.
I'm not that negative on the home price. It is where it is because of those factors. Now, do we fix it? My concern is, we've only gone 2 rate hikes, a quarter point and a half a point. We're up 0.7%, which is not really tackling inflation. So my question to the Federal Reserve Board is, do you have the guts to really do what you think you can do? And I've seen them try to raise interest rates in 2008. The stock market was down 20% before you could blink an eye. And I've watched them try to raise interest rates. This is 28 years of me doing it. They try to do it 3 or 4 times, and it doesn't work out well when they try to do it. So I don't think they're going to be able to tackle 8, 10, 12 rate hikes and get to 4%. So that's good news for mortgages, but it's bad news that inflation is going to persist if you don't try to get inflation down. And that's how you're going to do it. Raise interest rates higher than inflation rates. You will bring inflation down. I just don't think they're going to be able to do it. So I'm very bullish on inflation persisting for longer than most people think. That's my view on the inflation. And then I just can't tell you about interest rates because they set the interest rates through the Fed funds. And I just don't think they have the guts. Something's going to break before they get to 3, 4, 5%. So that's the good news on housing. I just don't think that they could get interest rates high because the stock market's not going to like it. And if the stock market's down 30%, do they continue to keep on raising interest rates? That's going to be 100%. If it comes down a little bit, that's expected.
All right, look, here's the takeaway. If you do not own a home and you have a timeline, if you don't own a home, you don't own a home because you're a corporate worker and you're moving around a lot. Okay, fine. I agree. Maybe it makes more sense to rent because you're going to have to sell soon. But if you're somebody that has stability in terms of where you're geographically located, you should try to persist and buy a home no matter what market is, because eventually rates will come down and then you can refinance that mortgage. If you end up buying something else in the future, you're going to exchange at the same time. So if the market comes way down, guess what? You get to buy your bigger home at a lower price. yeah, you're selling your smaller home that you bought at a lower price too, but you're exchanging at the same time, so it doesn't really matter. All right, we're 6 minutes over schedule. I like to stay on that 30-minute mark for all of our viewers and our panelists because we're all busy. We have to get going. So what I want to do here, I just want to show one more slide here, which is the contact information of our panel. These are really great people. And here's all the contact info of everybody on the panel. Thanks everybody for being here. It was a pleasure. We'll see you next month. Take care.